Hello, thanks for joining me. I'm Maura from Do Money Like It Makes Sense. We are on the Manage Your Lifestyle portion of the financial pyramid. And when I originally started to think about debt and debt reduction, I realized that I needed to break it into several components. So we've already talked about credit. You can find that on another video. Today we're going to talk about some of the things the banks look at in addition to credit. So again, we are on that debt credit line of the Manage Your Lifestyle portion of the pyramid. So debt is the money you owe and credit is the money you can borrow. So typically, you're borrowing money to pay for cars, to build your business, to manage emergencies if you have to, credit cards, etc. That is all credit you can have access to. The debt, the amount of money, is the money you owe. And borrowing money and accessing credit allows us to buy the things and experiences we don't have the money for: houses, car, furniture, education. You've seen that in a previous video. So what kind of debt is available? Well, lots. So mortgages, lines of credit, personal loans, credit cards, payment plans, vehicle loans, and leases. So remember, if you've got a credit card that has $10,000 as the amount that you can borrow, if you don't have a balance on it, then it's not debt. As soon as you put a balance on it, then it becomes debt. Is there good debt and bad debt? So some people say a mortgage, for instance, is good debt, and some people say credit cards are bad debt. I think as long as debt is used and it's in control and used wisely, and it is used to forward a good lifestyle and you have a plan to manage it, it's neither good nor bad. It is a tool. Just a note on how does debt make us feel. Some people aren't worried about debt. Some people become anxious when they're carrying debt. Some don't think about it at all. Some want to get it paid off right away and hate being in debt. And some people won't access debt even though it would help them achieve some things more quickly, like starting a business or, paying for a training course that they want or something like that, that is going to have a positive long-term effect. So that's something to be aware of also. And some people are resigned and think there's no way out when they have debt. So how do lenders decide how much you can access? Well, in a previous video, we reviewed the 5 C's of credit, so you could take a look at that. It is on my YouTube channel. And there are additional guidelines that lenders use to decide what you'll be able to borrow. Of course, they're using your credit scores and credit reports, and you can check that out. And there are some actual ratios or percentages that they're looking at. One of them is total debt service ratio. One of them is gross debt service ratio. I'm going to review gross debt service ratio first. So that's the percentage of your pre-tax income that you'll use to pay for housing costs, including mortgage payments, heating costs, property taxes, and if applicable, condo fees or a portion of condo fees. So you total your mortgage payments, your property tax, heating costs for 1 year, half of your condo fee. Divide this by your annual pre-tax household income and multiply this number by 100 to get your GDSR. Maximum GDSR should be less than 39%. Some lenders will want to see GDSR to be less than 32%. So if you're close to the guideline max, you may find your approval takes a bit longer, is more difficult, and the interest rates you're approved for could be higher. However, if you have good credit and a reliable income, often borrower lenders will exceed those guidelines. So total debt service ratio is all of that stuff, and debts and loans, how to cover those in addition to the cost of servicing the property and the mortgage. So principal, interest, taxes, heat, etc. So it's like GDSR and more, all your debt on top of that. So you're adding your total debt to your basically your GDSR payments, your property taxes, your mortgage payments. Add the sums in steps 1 and 2 together, divide this total by your annual pre-tax income, and multiply the number to get your TDSR. So CMHC Housing Corp says it should be less than 44%. And if you are close to the guideline max, again, approval may be more difficult and the interest rate you are approved for could be higher. You can get approved if you've got good credit and good, reliable income. So aim for 44% is at the high end, and it will leave you feeling a bit stretched. So when you're considering taking on a debt, it's not just the immediate thing, the car, the house, the loan, the line of credit. You may get approved up to a maximum, and if you use the total maximum of your available debt, will that leave you with enough disposable income to live life comfortably? Or are you going to be what some people would call house poor? Or are you feeling strapped and you're feeling like you can't move? Well, then you're taking on too much debt. And do you have enough emergency savings or any insurance in place to deal with the unexpected? So if we can pay all our bills when everything's going along great, that's fine. And we need to be prepared in case things aren't going great, in case of a job loss or in case of an emergency that we've got to deal with. So getting the loans is just one part of the equation. Our next session will be on managing debt, strategies and solution, and the emotional impacts of debt. I know this was just a sort of an overview, a light touch on how we get our loans in place and how we acquire debt. Please follow along. As you know, I believe if we manage to touch everything on this and review everything on this financial pyramid, you're going to be in good shape. You'll understand the consequences of your decisions and be able to make great choices. Thanks for following along. I'm Maura from Do Money Like It Makes Sense. Have a great day.